You've seen 10% RWA yield tweets. The real question is, what's genuinely risky, what's just mispriced, and what's a scam? In this module, you'll build a practical risk toolkit so you can dissect any RWA deal with the same confidence you already bring to DeFi. Real-world assets combine two risk universes you already understand. At the core is traditional asset and credit risk. Can the borrower pay? And is the collateral real and valuable? Around that sits legal and counterparty risk from SPVs and service providers. On top of it all, you get the familiar crypto stack: smart contract bugs, liquidity shocks, and governance failures. Whenever you see an RWA yield, picture three pillars holding it up. Pillar 1 is asset and credit risk. What actually backs this token, and how likely is it to default? Pillar 2 is legal and counterparty risk. If things go wrong, do you have an enforceable claim on real assets with credible actors in the middle? Pillar 3 is protocol and liquidity risk. Where can the on-chain structure or markets break? If any pillar fails, the yield thesis effectively collapses. To understand default risk in RWAs, split it into who pays you and what structure you're exposed to. On the payer side, governments tend to default last, then large corporates, then SMEs, then consumers. That hierarchy should roughly match the yield you're offered. On the structure side, a single borrower is binary. A pool diversifies but can hide concentration, and a multi-asset portfolio adds another layer of complexity. When yield looks unusually high, assume you're paying for extra risk somewhere along that chain. When a protocol talks about collateral quality, it's really asking how big a buffer is needed between asset value and loan size. That's the loan-to-value haircut or equity cushion. Higher quality collateral lets you lend more safely against it. To judge quality, focus on three things: liquidity, so assets can be sold quickly at fair value; valuation, ideally from independent appraisers; and update frequency, so prices are refreshed before small issues compound into big losses. Looking at an RWA pool, don't get distracted by the word diversified. Ask two concrete questions: how concentrated is it, and how correlated is it? A few giant borrowers or a very high top 20 share means one default can wreck returns. Many smaller positions can still move together if they all rely on the same macro factor, like US real estate or a single sector. Prefer structures with hard, on-chain concentration caps, so no single borrower can quietly dominate the risk. Different RWA asset classes sit on a spectrum of risk, yield, and liquidity. Government bonds focus on credit ratings and tight spreads over the risk-free rate, but they trade with very strong liquidity. Corporate credit pushes you toward covenants and sponsor quality, with moderate yield and decent liquidity. Receivables and trade finance make you care most about the underlying obligors and dilution risk, offering mid to high yields and typically short-term liquidity. SME loans require strong underwriting, offer the highest yields, and are usually the hardest to exit when you want out. Asset-backed in RWA marketing sounds comforting, but you need to ask, backed for whom and with what legal teeth? Legal enforceability comes down to whether you hold a direct, senior claim on specific assets, a shared claim on a pool, or only a vague promise from an issuer. Those positions can lead to very different outcomes if the structure blows up. Every RWA structure really has three legal locations: where the asset sits, where the issuer entity is domiciled, and where token holders are based. Each extra border between those points adds friction. More regulators, overlapping tax rules, and messy questions about which court is in charge during a dispute or default. As an investor or builder, you want this triangle as tight and simple as possible, especially for enforcement when things go wrong. Next, zoom into the operational pipeline. Who actually touches your money? The originator finds and underwrites loans. If their underwriting is sloppy, or they lack skin in the game, everything downstream becomes fragile. The servicer handles collections and cash flows. Operational failures or commingled funds can wipe out what looked like safe yields. The custodian or trustee safeguards assets and records. Weak bankruptcy protections or poor audits can undermine your legal claim when you need it most. Smart contract and protocol security for RWAs centers on three areas. First, audits and code. Is the code public, recently audited, and covered by credible bug bounties, or are you effectively trusting a black box? Second, upgradability. Who can change the contracts, through what process, and with which time locks or pause powers in emergencies. Third, Oracle dependencies. How do prices, NAV, and reports reach the chain? And what happens if those feeds fail, lag, or get manipulated? Governance in an RWA protocol is really about who wields emergency powers like pausing, seizing, or changing terms. A small multisig can act quickly, but concentrates risk and invites opaque decisions. A broad DAO is slower, but tends to be more transparent and aligned with users. The critical lens is incentive alignment. Do the people with power win or lose alongside RWA yield token holders when things go wrong? Liquidity in RWAs comes in two flavors, primary and secondary. Primary liquidity is when you deal directly with the issuer. Pricing is predictable, but you face frictions like notice periods, size limits, gates, and fiat rails that can jam under stress. Secondary liquidity is market-based and feels instant, but you pay in slippage, spreads, and dependence on pool depth. If the token trades daily but the underlying asset doesn't, that timing mismatch is a core structural vulnerability. All of this RWA risk work should drive to one simple decision: how big a position you're willing to hold. If credit, legal, and protocol pillars all score high, it's a candidate for your core book with meaningful size. If the scores are mixed, you only touch it for a clear yield premium and treat it as a tactical, not core, exposure. If any single pillar outright fails, the decision is straightforward. Zero allocation, no matter how attractive the APY looks. Use these checks as hard filters, not soft suggestions. If the legal docs are fuzzy or missing, you don't need more research. If nobody independent has audited either the contracts or the books, assume the risk is mispriced. If yields massively beat normal market rates with no solid explanation, you're being paid to ignore something. And if power is hyper-centralized, you're funding trust, not code. When in doubt, step back and protect your capital.